Hello financial fans, welcome back to another stock analysis. Today we'll be covering L'Oréal Paris stock ticker OR on Euronext Paris. L'Oréal is a multinational cosmetics and personal care company that specializes in the production and sale of various beauty products such as makeup, skincare, hair care and fragrance. The company was founded in 1909 by a French chemist named Eugène Schueller and is currently headquartered in Clichy, France. L'Oréal is one of the world's largest cosmetic companies with operations in over 150 countries and a diverse portfolio of 30 international brands such as Maybelline, Garnier, Lancôme, and Redken. The company's products are available in various retail outlets such as department stores, drugstores, and supermarkets, as well as online. L'Oréal is dedicated to research and development and invests heavily in scientific innovation and technology to create new products that meet the changing needs and preferences of consumers worldwide. The company has a team of over 4,000 researchers working in 23 research centers worldwide, developing new ingredients and testing their safety and efficiency. In addition to its focus on innovation, L'Oréal is also committed to sustainability and social responsibility. The company has implemented various initiatives to reduce its environmental impacts such as sourcing renewable energy, reducing water consumption, and using more eco-friendly packaging. L'Oréal also has programs in place to promote diversity and inclusion, support women's empowerment, and address social and economic inequality. They are currently sitting at a market cap of 201.3 billion euros, and in 2022 they generated a revenue of 38.3 billion euros, and their dividend yield is currently sitting at 1.59%. 40% of their revenue comes from skincare, 21% from makeup, 15% from hair care, 11% from perfumes, 9% from hair colorants, and the remaining 4% from other various income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT of L'Oréal has gone up over the years, going from 3.7 billion euros in 2013 to almost 7.5 billion euros in 2022. The average EBIT growth was 8.3% annually on average, meaning no change in the margin of safety. The margin has also increased, going from 16.82% in 2013 to almost 19.5% in 2022. The average margin growth was 1.7% rather, which is a 5% deduction in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from €1.80 a share annually in 2011 to €4.80 a share in 2022. The average growth in dividends during this period was 9.5% annually, which is a 5% deduction in the margin of safety. This with the payout ratio sitting at 40.4%, which is no change in the margin of safety. The final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For L'Oréal, this is almost half a year to pay off everything. In this case, a 41% debt to EBITDA ratio, meaning a 5% deduction from a margin of safety. And the return on invested capital for L'Oréal is sitting at 13.6%, indicating that their management is very efficient at allocating capital, which is a 5% deduction from a margin of safety. Looking very good so far for L'Oréal, so let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of L'Oréal going from 2013 to 2022. The average growth rate annually in free cash flow during this period was almost 4.3%, and I'm projecting an expected growth rate of 4% over the next 10 years annually in the free cash flow. With this percentage, we can determine the future free cash flow for L'Oreal and determine the terminal year valuation, using a perpetual growth rate of 2.5% and a discount rate of 8%, which leaves us with a sum of free cash flow of 97.5 billion euros. And to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of 93.9 billion euros. All that's left to do then is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of 405.80 euros, which is an 8.21% upside from the current price. The second model we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was 8.09%, and I'm projecting an expected growth rate in dividends for the next years for L'Oreal of 7%, and we'll be once again using a discount rate of 8% in this valuation, giving us a dividend discount model price per share of 513.60 euros, which is almost a 37% upside from the current price. The third model that we'll be using is the Graham's advice valuation formula. In this model, we will be looking at the earnings per share that L'Oreal is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. Keep in mind that these corporate bonds are currently European based rather than United States based, so they may differ from United States stocks. And we go by the theory that a PE of a company with no growth is always 7. And looking at all of these metrics, we get a fair value of exactly 200 euros, which is almost a 47% downside out of this model. The fourth model that we use is the multiple valuation. This model will be looking at similar companies to L'Oreal, looking at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 30.46. And to get our fair value then, we have to multiply by the amount of earnings per share that L'Oreal is generating, which is 10 euros per share, giving us a fair value of 304.57 euro, which is an 18.78% downside out of this model. And the last model that we'll be using is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case I've imported the dividend yield of the past 5 years, and on average this yield was sitting at 1.42%. Meanwhile the current yield is sitting at 1.59%. Indicating that it's currently cheaper than the last 5 years. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been 32.16 and the current PE ratio is 37.55, meaning that it's currently overvalued on this metric. Taking both of these metrics into account, we get a fair value of 370.82 euros, which is a 1.11% downside of this model. If you want access to all of the models that I use in my videos, you can check my Patreon link in the description. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of 358.96 euros. We've determined a margin of safety earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, 5% for the margin growth, 5% for the return on invested capital, 5% for the dividend growth, leaving us with a margin of safety of 5%. Applying this margin of safety, we get a fair value of 341.01 euros. And with the current price of 375 euros, we get a downside of 9.06%, so it's currently indicating a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.